Hello, everyone. Today on the Final Bar, I'm excited to talk to Sam Stovall from CFRA Research. We'll talk about sectors. We'll talk about the market environment. We're in the seasonally strongest part of the year, I've been told, but it doesn't necessarily feel like that. The strength that we saw from the growth trade yesterday going into the close, reversing to the downside very quickly with the technology sector leading the way to the downside. What does this mean for the overall environment between now, year end, and beyond? Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to today's edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using the power of StockCharts, using the technical analysis toolkit to better quantify investor sentiment, investor behavior, looking at the messages of price, breadth, and sentiment to better understand the dynamics, the underlying dynamics of the market. And you've certainly seen a difference between yesterday's action and today's action, sort of the muted, pregame before the Fed meeting yesterday, the rally, the sudden move to the upside as the market sort of initially reacted to the Fed decision. But then today, you get what may be more of an expected reaction, I guess, based on the prospect of higher rates. You sort of see the cyclical stuff working and you see the growthy stuff not working. That's kind of the theme that makes sense to me. But again, the market rarely cares what makes sense to you as an investor. It's all about the aggregate, reaction, the aggregate sentiment, the psychological state of all the investors that pool their capital together and make different movements. We're going to focus a little bit on sentiment a little later in today's show. We have a segment where we'll focus on things like volatility, which remains fairly elevated, looking at survey data with one particular survey that is a bit concerning. We have great guests on the show. I'm excited to talk to Sam Stovall today. Also wanted to highlight some of the other really cool events between now and the end of the calendar year. We just a little while ago finished recording The Pitch, our latest episode. This is our monthly stock picking showdown featuring 3 different guest experts. Today, I moderated a discussion with T.G. Watkins from Simpler Trading, Aaron Swenlin from Decision Point, Larry Tentarelli from Blue Chip Daily. We had a lot of fun talking about these questions I proposed in the intro to today's show, and they each had 5 picks each on how they would play this current environment. Also, starting on Monday the 20th, we have the next 2 weeks. We'll be taking live shows off on the Final Bar. A lot of our shows will be replaying some information, also showing a lot of really cool year-end content. On this show, all next week, starting the 20th, we will focus on the top 5 charts of 2021, some key charts that tell the stories that I think you should be aware of as you wrap this year. And then the next week on the 27th, we'll start a series focused on improving your process, how to review your performance as an investor year to date, how to reflect on how you've done and hopefully make some improvements. Also, all the next 2 weeks at 11 a.m. Eastern, every day, a different guest expert is going to present to you a top influential event of the market for 2021. Over 10 days, you will get the top events from a technical perspective. It's going to be fantastic. So a lot of year-end programming coming your way starting on Monday, the 20th. Let's continue on today's show. We'll talk about the market environment. And I'm looking at the preview chart here on my dashboard, looking at yesterday and today with the NASDAQ composite. I would say this 2-day period fits into 3 categories. The day before this, right, or the 2 days before this, sort of that down move leading up to the Fed meeting. And when I'm asked, why the market rallied going into the close, we talked to Ms. Schneider and I yesterday on the show, talked about, what was causing that. And her comment, which I think was totally fair, was there's a lot of negativity priced into the market leading up to that announcement, right? So people had sort of been preparing for some negativity when it was maybe not as negative as people expected. You get that bounce higher. But as we were talking on the pitch earlier today, I think T.G. Watkins had mentioned that, he has learned that the period right after the Fed announcement, that next couple hours, has rarely been a great indicator of the overall environment. You saw a great bounce yesterday, but at this point, it appears certainly to be sort of a bounce, a short-term bounce. Today was more the expected I think way that the market digests the reality of higher rates going into next year and beyond. So let's set the stage on how things sort of played out today. The S&P down almost 1%, about 0.9%, closing once again back below 4,700. Now gapped above there or traded opened above there through the course of the day, getting lower and lower, around 4670 for the close. The NASDAQ composite, the NASDAQ 100, both down about 2.5%. So certainly leading the way lower, with tech the worst of the 11 S&P sectors. The NYSE composite, notably the only major index we track here on the front page, just up a slight bit, less than 0.25%. Mid caps and small caps down as well, a little more than the S&P, with the small cap index down 1.6%. The VIX back above 20. Other asset classes, we have interest rates coming off today. The 10-year yield in particular getting lower and lower, closing the day around 142. The long bond up a little bit with the 30-year yield around 186. The dollar index down about 0.5% today, a little less than that, 0.4%. That's worth watching, right? This stronger dollar environment has certainly been the theme here for a lot of recent months. This uptrend, and that's fueled U.S. outperformance of non-U.S. stocks fairly consistently. Any sort of change in that trend would certainly be a noteworthy a reversal of trend. In the commodity space, you have commodities as a whole higher, and a lot of green on this particular page. You have gold up 1.2%, silver 1.8%, crude oil prices higher through the course of the day, and the energy sector up as well. Cryptocurrencies overall mixed, but for the most part, a lot more red than green here. We have Bitcoin down about 1 2/3%, Ethereum up about 1/3%, right around that 4,000 level. Spent most of the day bouncing off of 4,000. I'm thinking of the last 24-hour period. This is after that big spike higher yesterday afternoon. Bitcoin off a little bit, right? And spending most of the day, the equity trading session day coming down below 49,000, now trading right around 48,000. Let's look at a chart of the S&P 500, just sort of look at how this day fits into the big picture. We're actually going to start with a zoom in on the candles, because it looked like it was going to be a dark cloud cover, which I think I would say it probably is. So a dark cloud cover candle is a short 2-bar pattern. And please don't hate me for starting in with a very short-term look. We focus a lot more on the longer term, and I think that is appropriate. This is a noted, I think, an interesting pattern to note. When you have a market moving higher, you have a big up day and then a down day where the second day does not engulf the first day's range. That would be a bearish engulfing pattern, but it comes off and you have a big long up day, a big long down day. You have a higher open than yesterday's close, and you close at least 50% of the way down through the body. It's called a dark cloud cover candle. And again, the naming is less interesting to me, as is the outlook. And what that does is it tells you short-term weakness. Basically, think about it. We had a big rally yesterday. We opened higher, which is encouraging, but by the end of the day, we gave up all those gains and much more and traded about halfway down. If you'd continue to go lower and close below yesterday's open, that would indeed be called a bearish engulfing pattern. But at this point, it's a short-term bearish candle, sort of the flipped over version, the opposite of what you saw here at the beginning of December, a big lower candle, an up candle that finishes at least halfway through the first day. That's called a bullish piercing line. I'm mentally digging into the CMT curriculum to come up with those names. And again, the names I'm less interested in. I'm more interested in the dynamics. So a big down day followed by a big up day. And it's indicating a short-term rotation from distribution to accumulation. We're seeing the opposite here. Short-term accumulation followed by some signs of distribution. That tells you the next couple of days more likely weaker than stronger. Again, all else being equal, worth noting. And that's worth noting just as the last bullish signal you saw was hitting the 50-day moving average, which is an important level. Today, yesterday, really into today, we're hitting the 4,700 level, which for the last 6 weeks has been the level. That's been the line at which the S&P has failed to push higher. So once again, back below 4,700, bearish sort of short-term distribution pattern suggests some weakness going into the end of the week. Now, the longer-term view of the S&P, as we've talked about, overall, let's remember, we're not too far off of all-time closing highs. We made a new intraday high almost today. It was the second highest level. Didn't quite get above the peak that we achieved in late November, but we got up into that area. Weren't able to close, obviously, to a new closing high today, closing back lower. But overall, we are not far off of all-time highs, and that's worth noting. So the market trend model that we talk about on the show, looking at different time frames, overall strong across the board. What concerns me are some of the measures of breadth, which we may have time to talk about here in a moment, signs of a weaker momentum. And if you look, early November, late November, now mid-December, every time the S&P has tested 4,700, there's been less and less momentum behind that upward move. A strong, resilient bull market phase sees consistently strong momentum as the market is able to make new highs. A market that is unable to make new highs is more of a stalled market, is how I would describe it. And the momentum coming off is certainly not an encouraging sign. That's more of a negative sign, telling you that there's some underlying weakness to be concerned with. Just to finish off here, just to highlight one more time, I think this we've talked about this being a rotational environment, and hopefully I'll be able to ask Sam Stovall a little bit about that rotation that we've seen. This I would describe 2021 as rotational. If I had to pick an adjective, that might be it. Today you have financials up, materials up, consumer staples higher, energy stocks higher, even healthcare. But on the downside, you have technology and consumer discretionary. Everything else is sort of flat to a little net positive. So it shows you with things like financials and materials higher, things like tech and consumer discretionary lower. There's so much cap in those sectors that are down. That is what is going to hold the S&P well below the zero level, and that's why you see the market struggling quite a bit today. We need to take a quick break. We'll be back with today's guest, Sam Stovall. We'll see you in a minute. Everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Really appreciate you joining us every weekday after the close as we focus on the markets using the technical analysis toolkit, trying to understand market dynamics the best we can in uncertain times. A couple quick announcements before we get to today's guest, Sam Stovall. First off, we love to get your questions. Anything that comes up as you are analyzing charts, as you are using the StockCharts platform, as you're trying to introduce or incorporate technical analysis into your decision-making, we are here to help. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air on our next mailbag segment tomorrow on Friday's show. Also, go to StockChartsTV.com. That's our on-demand platform. Great guest appearances like Sam Stovall, Tony Dwyer, Mark Chaikin, Miss Schneider. We've had so many great guests recently. And also all of our special events. The Pitch coming out later this evening, our year-end review coming up in December, our market outlook specials in January. All of that on demand. Go to StockChartsTV.com or on your mobile device, just search for StockCharts TV on demand. I want to welcome on today's guest, Sam Stovall. Sam's the Chief Investment Strategist at CFRA Research. Sam, it's awesome to have you back on the show. Welcome back.
Thanks, Dave. Good to be here.
I've promoted your appearance saying that you literally wrote the book on sector rotation. I remember one of the first things when I was trying to understand how these markets work, I was introduced to your methodologies, your thinking about how to look at rotation. And again, as I mentioned in our intro, I feel like rotational is a way I would describe this. Now we're at that part of the year where it tends to be a little stronger. Show us within your toolkit, how are you making sense of this current market?
Well, I think that the market right now is being bombarded with UV rays, meaning uncertainty and volatility. That basically it's normally a pretty strong period, the second half of December. And then as you head into the early part of the new year, that's typically the strongest period for the markets. And it's then that May through October period that is relatively challenging. But we're coming into a new year, and you could say, well, things look good because we're coming off of a 20+% gain in 2021. That implies about a 10% advance the year after. But at the same time, we are in what, or will be in, the sophomore slump, the second year of a president's term in office. And what this chart shows, the 4.9 is the average price change, which is the worst of the 4 years. And if you then circle those two negative quarters, the second and third quarters, as we head up to the uncertainties surrounding the midterm election, that adds to underperformance. And then on the right-hand side, standard deviation of returns for the two quarters, second and third quarter, they are 30% and 80% higher than the average for the other 14 quarters. And the standard deviation for the full year is 40% higher than the other 3 years. So just, if you were Rip Van Winkle and you just woke up and looked at the second year of a president's term in office, this is the kind of return and volatility that you would expect to see, not necessarily reasons behind it, which we can get to next.
Yeah, I feel like the way you're describing this, if you love uncertainty and volatility, it doesn't look like that seems to be changing anytime soon. Now, bring the Fed into the picture. Obviously, Fed Week, a lot of focus there. How does that relate to what we described?
Well, usually the 6 months before the first rate increase, going back to 1946, the S&P was sort of whistling past the graveyard, up 7.7% on average, and that's the blue chart. Compare that with how the market typically does 6 months before the first rate cut, and that's the orange bar. Once we start getting rate increases, however, as seen in the 1.3, the uncertainty takes over for that 6-month period, and then it gets a little bit better over a 12-month period, but still a lot less than what we see during rate cuts, and also a lot less than we see during all periods.
Very interesting, and boy, I'm starting to get less and less excited about 2022. I was looking for some sort of recuperation year, but it seems like we've got plenty of uncertainty now. Bring valuations into the picture here on your third chart.
Well, what I did here was I went back to 1945 and looked at essentially where were we on the 10-year yield, and if we were between 0 and 1%, the average PE was 22.5. If we were between 1 and 2, the average PE was 18. Between 2 and 3, it was 15.5. Interesting how we bump up, heading up to about a 6% level, but that's because you have more observations in that 6% level, because the average going back to World War II is about 5.5% on the 10-year note. But obviously the trend is downward. There is a negative 0.5 correlation between PE ratios and interest rates. So the higher the 10-year yield goes, the more PE contraction we're likely to see.
So we only have about a minute left, Sam. This is fantastic stuff, and I'm not surprised. You tend to bring just some great data behind you to try to make sense of things. So given that environment and given the rotation we've seen, where do you look for opportunities now going into the first quarter, given the prospect of higher interest rates, given all the uncertainty, the Omicron virus and the Omicron variant and so forth? Where are you looking opportunistically now?
Well, the market has been very good at climbing a wall of worry. We are still in a favorable seasonal period. So those groups that are beaten up the most, which are some of your growth areas, but then at the same time, cyclicals, communication services, tech, energy, and materials, we're thinking could do relatively well. But then, as you said, be careful of the rotation that is likely to take place. If this does end up becoming the 1970s all over, the best performing sectors were energy and materials, along with staples and utilities, whereas the worst performing sectors were consumer discretionary and tech.
Sam, it's awesome to see you. Thanks so much, as always, for coming on the show, sharing your investment wisdom with them. Hope you have a great holiday season. We'll see you in the new year. All right.
Thanks. You too, Dave.
That's Sam Stovall. Sam's the chief investment strategist at CFRA Research in New York. He's an incredible source of investment wisdom and market history. And as we're looking at that, you see the how to think about. I love the way he was portraying how to incorporate all these different sort of competing pushes and pulls to the market. We have a interest rate environment that's in flux. We're looking at potential headwinds and tailwinds to some of the sectors. But at the end of the day, it's all about how this current environment fits into the seasonal tendencies. And it's interesting to see we're in the stronger half of the year now, November through April. Certainly worth thinking about how the new year starts, where we can find some opportunities. Great takes there from Sam Stovall. Let's continue on today's show with our next segment called Getting Sentimental. What we love to do usually on Thursdays is take a look at some of the sentiment indicators. I'm really interested to share this segment with you today because there's been some changes in some of the sentiment readings we look at, particularly one focused on money managers and how they're positioned. We're going to start, however, with the volatility picture with the VIX. I love Sam's comment about UV rays, uncertainty and volatility. That is the phrase of the day for me. When we're looking at volatility, looking at the VIX, right? The VIX remained relatively low. If you think of the last, the previous 18 months as normal, think of the elevated volatility we saw in 2020, early 2021. Much of 2021 was sort of in that 15 to 20, maybe 25 range on the VIX. And that ended up being a fairly good indication of buyable pullbacks, of tradable swings within this long-term uptrend, right? I mean, if you see this consistent uptrend from the March 2020 low, obviously with some pullbacks of sorts along the way for sure, but overall, particularly April through November, it was a fairly cyclical pattern of seeing a spike in volatility, the pullback in stocks, and that would set the stage for the next move higher. This at the end of November started to have a bit of a different look to it, where you saw the volatility index get above 25, push above 30 for the first time since end of January of 2021. Now we're right back at that 20 range. And if you look, we're almost at the median of where we were at last August to where we're at this blue horizontal line right around the 20 levels. You can see how we spent a good amount of time above, a good amount of time below. Now we've chopped around and sort of settled right into there. I've seen very few people talking about 2022 and expecting less volatility than we've seen so far. Certainly, I think an expectation of greater volatility, greater uncertainty seems to be the story. So, be worth noting to think about how the market will feel a lot more maybe like the end of 2020, beginning of 2021 from a purely technical perspective, relative to or compared to more of a steady gaining market that we saw over the summer months in 2021. But that's where the VIX is at, really at the median level that it's been since last summer. The AAII survey, not a ton of change. However, you're seeing an increase yet again on the bearish side, right? So last week, you had a bit of a change where bears had dried up a bit. There was an even number relatively speaking between bulls and bears, right around 27%. You can see that the spread between the two was right around the zero line. This week, however, getting back net negative. And really, there's been a lot of weeks where we've had a net negative reading. Mid-October to mid-November was when it turned more positive, and that was indicating an overall bullish feel to the market. From there, though, it's been net negative. You're having a lot less bulls, 25% bullish on this week's reading relative to almost 50% bulls at the beginning of November. So the last 6 weeks, certainly a decline in bullish readings and quite an increase in bearish readings from around 24% down to 39%. So you've seen quite a number of investors go bullish to neutral, neutral to bearish, or even switching between the two. And overall, a lot of skepticism on this most recent move higher into 4,700. This is the chart that I alluded to earlier that I wanted to make sure we spend a minute or two on. This is the NAIIM Exposure Index, a National Association of Investment Managers. This is a survey of money managers and where what their positioning is in the equity markets. And you can respond to that survey 200% long, 100% long, 0% equity, 100% short, or 200% short. It aggregates all those and gives you the aggregate reading, the average reading based on all of the respondents. About a month ago, this was above 100%. We had this 6-week period where we were consistently right at or even above 100%, which told you on that move higher as the S&P got into early November, made new all-time highs yet again after many new all-time highs through the course of 2021. Money managers, according to this survey, most bullishly positioned since the first quarter, since January and February, which is really we're coming out of year end and making new swing highs and really setting the stage for a nice rally through the course of this year. So what's happened in the month since the last 3 to 4 weeks is you've seen that reading come from around 105%, 104%, I think, down to 52%. So it's literally been halved. This is now one of the lowest readings that we've seen in 2021. We've just been this low a couple more times back here in May, back here in March, with the two other times when we saw this level or this lack of bullish positioning. I don't know if this survey has ever gone below 0%. I'll have to look at that. I don't believe so, but I may be wrong. I've been wrong before for sure. I'll have to dig into the deeper data set to see what I can find. But certainly, since I've been following it closely, it tends to rotate in sort of the 50 to 100% long region, and below 50% is certainly going to be in line with more of the deeper corrective periods that we've seen. Again, the only times it's really gone below 50% and remain there would be, February, March 2020. Really didn't even get that low until the beginning of March of that year. Late 2018, this is after the market broke down through some long-term averages, started to really accelerate into the low in December. Then the other times would be back here 2015, 16, which was a sort of an extended corrective period. Ended up being a little more of a time correction than a price correction, but plenty of deterioration with the S&P coming from 2100 or so down to around 1900, eventually down to getting down to 1800 before rallying and renewing the uptrend through the course of 2016 and 2017. So I'm very interested when I see a survey of money managers basically saying we were very leveraged long about a month ago, and now we're way more defensive. This feels a lot less like just taking the foot off the accelerator and more like stomping on the brakes and trying to stem the tide of downward pressure here. So certainly worth noting that that change in character according to money managers. The RIDEX flows, by the way, remain fairly low, and I have this chart inverted because it's more in line with the sentiment readings, where a high reading is very bullish positioning and it's sort of a contrarian bearish reading. A very high reading or low on the chart would be negative bearish positioning and sort of a contrarian bullish signal. At this point, you're seeing it still remaining very, very low, very high on this chart, which suggests that the RIDEX flows are overall remaining in a similar fashion than they've been over the last 6 weeks or so. That's it. A take on the sentiment readings, getting sentimental. And again, that change in the RIDEX or the NAIIM exposure index, I think is a really important one. The last 3 weeks, getting successively less bullish positioning. We need to wrap today's show. Go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1, we finished that look at sentiment, looking at the NAIIM exposure index. And again, if there's one chart to take out of that sentiment discussion, a number of these were interesting. I think the volatility picture is encouraging in terms of volatility. If you think volatility is good, I think you're going to enjoy the next stretch here as a market participant. When we did the pitch earlier today, I asked all about volatility, and pretty much across the board agreeing that sort of elevated volatility is more the norm going forward than the exception. But I'm very interested in seeing this pivot on the RIDEX flows, over the NAIIM exposure index over the last 4 weeks, going from 105% long to 52%, which is quite a change and suggests money managers are getting quite defensive. Now, you don't have to just look at survey data to see that investors are getting more defensive. You can see it on the charts. And that's why when I was learning about technical analysis, and I learned you don't really have to know what people say, you can see their opinions. Their opinions in terms of what they're voting with their capital is reflected in the price, right? It's based on supply and demand. It's based on fear and greed. And so when people get nervous or excited or desperate or euphoric or despondent, all of those adjectives should be reflected in the price of an asset. So when I see consumer staples breaking out to new all-time highs, and I see a lot of charts within that sector doing well, I have to be a little concerned about the overall strength of the market. And it's not just consumer staples. Wherever we look at the ratio of consumer staples versus consumer discretionary, clearly favoring staples over the last 4 to 6 weeks. You're also seeing rallies in other defensive areas of the market, like utilities, like real estate. These are places and types of names that people don't usually enjoy owning, particularly institutions, unless they're trying to hide out and ride out a period of uncertainty and potential downside pressure. So a rally in staples here is certainly encouraging if you're looking for ideas in the staples sector, but certainly suggests that capital is trying to get defensive here. The relative strength, by the way, making a new 3-month high today. Finally, I'll highlight there are a number of names that are highly rated within the consumer staples sector. I'd encourage you to employ the scan engine on StockCharts.com to find some other ideas, but I did want to highlight Constellation brands. I keep calling the stars, and maybe we've been watching too much streaming TV in our house, but STZ, it keeps coming out of my mouth, but I got it right. Constellation brands. A name within the consumer staples sector. Look at this cup and handle pattern. A cup and handle pattern is where you have a big rally higher. You establish a base, which is a level of resistance, which you did April and May. Then you have this rounding bottom pattern where you rotate lower distribution. You then have accumulation. You retest those previous highs, which is what we saw in mid-November. You pull back and then once again rotate higher, and breaking above the rim of that cup. If you think of this as the cup, and the handle breaking above the rim is what's most key. We saw that today. Overall, very encouraging sign for a big name within consumer staples. Folks, that is our show for today. Thank you so much for joining us every weekday after the close for the Final Bar. Special thank you to Sam Stovall from CFRA Research, joining us from Pennsylvania. Also, as a reminder, Go to StockChartsTV.com for all of our great content on demand. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.